Hello, everyone, and welcome to this session in which we will dive a little bit deeper into the statement of cash flows. And specifically, we're going to be discussing the operating section. Now, in the prior session, we looked at the introduction, and we said one of the sections is the operating section. In this session, we will focus on the operating section, specifically the indirect method. We have the indirect method, and eventually we'll discuss the direct method. Now, why is the operating section important? Well, here's what you are doing in this operating section. You're taking your income statement. I'm just giving you an overall picture before we dive in. We're taking the income statement, which is based on accrual accounting, and we are going to convert into what? Into a cash net income. So we're taking our accrual net income, turn it into a cash net income. And this is important. Why? Because whether you are an accounting student, a CPA, CMA candidate, converting from cash to accrual or accrual to cash, that's what we are doing now, is extremely important. Therefore, in this session, you need to have a good understanding of the income statement. Obviously, if you're preparing the statement of cash flows, you need to be familiar with this because this is what you are converting. You need to be familiar with the balance sheet. Specifically, on the balance sheet, you need to be familiar with current assets and current liabilities. Those are the accounts that's going to influence our current earnings, which is net income. So it's very important. If you don't have a good, strong understanding of your income statement or balance sheet, you might have to do a quick review. Otherwise, just follow along. I'm going to show you 5 steps in computing the operating section. I'm going to show it to you step by step. Follow it. Practice, practice, practice. We're always here for you. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Let's start by discussing what's needed. What do we need to prepare the statement of cash flows? Well, we're going to need 3 items. We're going to need a comparative balance sheet. What does that mean? It means we're going to need the current year balance sheet and prior year. And you're going to see an example and you're going to see why we need this, because we need to examine the changes. Of course, we need a comparative balance sheet because the whole purpose of the statement of cash flows is to find the change in cash. And where do we find cash? We find cash on the balance sheet. And to find the change, you need the current year and the prior year. That's the least, but we need the full balance sheet, and you're going to see why. We need the current income statement. So in addition to the balance sheet, we need the current income statement, the current year income statement. And we also need additional information about certain transactions. Now, why do we need those? Well, sometimes the numbers don't tell you the full story. There are other information, additional information that's needed to do what? To clarify certain transactions, certain numbers. And this is why we need that 3rd item. Now, we're going to see those 3 items step by step. I'm going to be using an example to illustrate the 3 sections. Don't confuse the 3 sections with the 3 items. They're both 3s. We need 3 items and there are 3 sections. In this session, we will prepare the operating section. In the prior session, we talked about what is the operating section is all about. And to summarize in a nutshell, taking net income that is on the income statement, that's accrual, and converting it into cash net income. We discussed what goes there. Now it's the time to actually prepare the operating section. To make it easy for you, I have 5-step process, 5 steps in preparing the operating section. Now those 5 steps, I use them. You may not see them in your textbook. You may not see them in your CPA review course or your CMA course, but those steps are useful. Some of the steps are easy. Some of the steps I'm going to spend more time than others. Starting with, guess what? You're going to start with net income, and that's a step 1. And step 1 is easy. Why? Because all what you have to do, you go to your income statement and pull net income, and you're done. That's a step 1. Because preparing the operating section using the indirect method is taking net income and converting net income into cash net income. Again, there's no such thing as cash net income, but I'm making the analogy so you understand. So I'm converting net income. I got to start with net income, and that's easy. Now, I said easy, but sometimes it's not easy. Sometimes you have to compute net income. Sometimes they might give you, for example, they might give you retained earnings, and they might give you beginning retained earnings and ending retained earnings. So they're going to give you the beginning number and the ending number, and they might give you the dividend amount. So what you have to do, you would say, okay, if my beginning was 100 and my ending was 200 and my dividend was 40, okay, so the only thing that's missing is net income. Net income, well, how much my net income should be? If I went from 100 to 200 and I reduced it by 140, it means my net income must have been 140. Why? So 100 beginning plus net income, that's 240, minus the dividend, because it's going to reduce net income, it's going to give me to 200. Here what I did is I computed my net income. Oftentimes in a financial accounting course, oftentimes net income is giving. Oftentimes. If you have to find it, you have to be familiar with retained earnings, how to analyze the retained earnings account. So that's step one. It's easy. Step two. Also, step two is fairly straightforward, and you're going to see that in an example. What you do is you scan the income statement. You look at your income statement. Remember, we have the income statement, and you would add, what do you add? You are going to add non-cash expenses. You're going to add non-cash expenses. What are non-cash expenses? Examples of them: depreciation, amortization, bad debt. It could be bad debt expense depending on how it's computed. So those are non-cash expenses, and don't worry, we'll work an example. Now, why do we add non-cash expenses? I will explain later. Once we get to the example, I will show you, because I want you to see the actual step. But this is the actual computation. But this is the second step. Again, this is pretty straightforward. Oftentimes, if you are giving the income statement, sometime you might have to compute or basically generate depreciation. Again, we'll work an example later on to see how do we do that. But if it's given to you in a financial accounting course, it's easy. In intermediate accounting, it could be a little bit more challenging. Nevertheless, the step is the same. You add any losses. Hold on a second. Add losses. Why? Don't worry. Just take a picture of this step, because as I'm working the example, I'm going to explain why. Then you deduct any gains. Why? We're going to explain that in a moment. And the fifth step, analyze current assets and current liabilities. And this would be the most involved. So this step will be the most, not difficult, the most challenging, and you're going to see why. Not challenging, you're going to have many items you have to deal with, and you have to have a good understanding when we say analyze current asset and current liability. So this step is important, like very, very important. And why this step is important? Two reasons. One, eventually we're going to look at the direct method, and the direct method, to get to the direct method, you have to have a good understanding on how to analyze current asset and current liabilities. And in your CPA review course, in your accounting courses, you might have to go from cash to accrual, or the opposite. You might have to go from accrual to cash, and this is what we're doing here. Knowing how to analyze account is important. So this step is the most challenging and the most important. They're all important, but it's the most challenging. So let's start with what we are giving. What do we need? We need current income statement. And here's the income statement that we are working with for a triple K company. We are giving sales, bunch of expenses, gains and losses, income before taxes, income taxes, and net income. And guess what? We're already done with step one, because in this example, I'm giving you net income. So starting with the income statement, then you are giving the balance sheet. You need a comparative balance sheet. It means 2 years of balance sheet. Obviously, the X05 is the current balance sheet, because X05 is more recent than X04. So current and the prior. And what you do is you compute the changes in the accounts. For example, here we went from 136 to 180, and there was an increase in the cash of 44,000. And basically, what's going to happen after we prepare 2 more recordings, we're going to figure out how did that increase came about, because everything that we're doing is to explain this increase in cash. This is what the statement of cash flows is all about. Then you compute the changes in all the account, and you're going to see how we're going to be using this. For example, account receivable went from 67 to 93,000. Inventory went from 186 to 213. Prepaid expenses went from 18 to 15. This is total current assets. Plant asset, changes in plant asset, changes in accumulated depreciation. Then you have to do the same thing with the liabilities. You compute the changes in liabilities, whether that's an increase or a decrease, and that's easy. But you're going to see how do we use this information. So remember, we need current income statement. That's item 1. We need 2-year balance sheet. This is the asset section. This is the liability section. So this is the second item. And the third item we need is additional information for the current year. And this is what we meant by additional information. Additional information is additional information, additional knowledge about the company transaction. For example, the accounts payable resulted from inventory purchases. So anything in accounts payable is the result of purchasing inventory. Triple K purchased 110,000 in plant asset by issuing a note. So if they bought plant asset by issuing a note, well, we need to know under which section this transaction would influence. Let's think about transaction 1. Accounts payable and inventory, they both deal with current asset and current liability. So this is needed for the operating section. What I'm trying to show you is where each statement, where will you need it later? Triple K purchased 110,000 in plant asset by issuing a note. Now, in transaction 2, the second additional information, the plant asset is an investing activity. The note is a financing activity. So you're going to see what we're going to deal with this later on. Triple K sold plant asset, which is an investing activity with a book value of 32 for 18,000, yielding a loss. Don't worry, we'll look at that later because here we're focusing only on operating. This has to do with investing. Triple K received 75,000 in cash from issuing 5,000 shares of common stock. This is a financing activity. Triple K paid 81,000 to retire notes with 100,000 book value, yielding a gain of 30,000. Again, this is part of how they are financing the company. Triple K declared and paid dividend of this much, 522,600. Again, this is a financing activity. So what you do is you go over each item and the additional information to find out where would this piece of information be needed when I'm preparing the statement of cash flow. Again, for all the information given here for the operating section, all what's needed is 1, and this you don't even need it. All what they're telling us is assume all the accounts payable as the result of inventory. Okay, that's fine and dandy. Now remember that 5 steps. Again, I told you to take a picture of it, so this way we're gonna use it now. We're gonna start with step 1. And what is a step 1? We said start with net income. Easy. I'm gonna take my net income. I'm gonna say Triple K statement of cash flows for the year ended X5. So this is step 1. So step 1 is done. You see how easy is step 1. Step 2, we said step 2 is scan the income statement, look for non-cash expenses and add them. Well, what are non-cash expenses? Depreciation expense. Now, why do we say this is a non-cash expense? Think of the journal entry. Think about when you debited depreciation expense, 82,000, what did you credit? You credited accumulated depreciation. We call this a non-cash expense. Why? Because expense went up and we did not credit cash. So this is an expense, but the cash that was not reduced. So what does that mean? Notice, to come up to 495,000, we deducted 82,000. This deduction is a non-cash. So if we deducted something that's non-cash, and now we want to take this number, 495,600, and turn it into cash, well, guess what? We have to add this number that we deducted because we deducted it without paying cash. Therefore, what I do is I take my 495,600 and I add my depreciation expense. If there are other non-cash expenses, such as amortization expense, I also will do the same thing. Now, that's a step 2, and this is step 2. Step 3, if you have what I told you to have, is look for losses and gains. What do I do with losses and gains? I am going to add back the loss. And what I did here to kind of make it easy for you, it's a loss. They sold the plant asset and they had a loss. And notice I put the negative here. There's no negative on the financial statement. I just wanted to show you that loss is a negative, just like expenses are, in quote, negatives. But I did this on purpose so you understand why am I adding this. Why am I adding this? Because when I sold this plant asset, we have the details of it. We'll analyze the transaction in the next session. But let's assume I purchased this asset originally. This is a piece of land. I had a piece of land and I purchased it for $114,000. Then I sold for $100,000. Well, if I sold it for $100,000, I have a loss. Let's book the journal entry. I debit cash. I sold it for $100,000. I have to remove the land for $114,000. Therefore, I remove the land from the T account. The land account is 0. Okay. Now I debit a loss of $14,000. Did I lose $14,000 in cash? And the answer is no. I did not have to pay $14,000 in cash. If anything, my cash went up in this transaction. However, I had to reduce my net income by $14,000. It's a loss. It's like an expense. But again, this is think of it as a non-cash loss. Why? Because I received cash. Therefore, what's going to happen? The loss will be also added because I deducted $14,000 to come up with $495,600, and now I want to convert the $49,600 to cash amount. I will add back any loss. I will add back any loss I deducted. So I'm done with this. Is basically part of step 3. Step 4 is take any gains and do what with the gains? Deduct the gains. Well, why? Well, let's think about that piece of land. That piece of land. Okay, so again, I have a piece of land, and I purchased that piece of land initially for let me delete everything because let's do with the gain. So let's assume for the sake of illustration, I purchased this piece of this land for, let's assume $100,000. I purchased it for $100,000. I sold for $130,000. What's my entry? I debit cash $130,000. I credit the land $100,000 because I sold this land. What I'm left with is a gain, and the gain of $30,000. Now this gain increased my net income. That's great. But did I receive $30,000 in cash? No, I received $130,000 in cash, not $30,000. Part of that $130,000 was a gain. Now bear in mind, I'm going to change color to make the point. This $130,000, remember, this is part of my investing section, because when I sold land, land is what type of account land? Land is investing. My screen skipped, okay? Land is investing section. Therefore, what's going to happen? This $30,000 that increased my net income, it's not really cash for operating section. Everything that I receive for this land is supposed to be in the investing section. So since I added it, now what do I have to do? I have to do the opposite. I have to deduct the land. And this is also, this is step 4. So notice how easy step 1, 2, and 3. Step 1 is net income. Step 2, add non-cash expenses, depreciation. Step 3, add the loss. Step 4, deduct the gains. Done. So I'm done with step 1, 2, 3, and 4. Now, what am I going to get to now? Step 5. And step 5 is a big step. Let me go back and show it to you. And what I said in step 5 is where you analyze your current assets and current liabilities. Why current assets and current liabilities? Well, because when you operate the business, you need current assets. What are the current assets? Current assets are account receivable, inventory, prepaid, supplies. Those are my current assets. And my current liabilities are, I buy stuff on account, I might accrue some interest, I might accrue taxes. Those are what? Those are accounts that are involved in my daily operation. Now, how do I analyze them? Well, I'm going to take a look at each account separately and compute the change. And this is where the change now is needed. So let me go back first and analyze the asset section and tell you what needs to be done when you're analyzing the asset section. So I'm going to start with account receivable. Obviously, we don't analyze cash because the whole purpose is to explain cash. So my account receivable, so I'm going to put it down here, account receivable, hopefully you can see this, went up 26,000. So let's do an analysis of my account receivable. This is my account receivable. I have the beginning balance of 67,000 and I end up with 93,000. So this is the beginning and this is the ending. Now the question is this. What happened throughout the year in this account? Throughout the year, I increased my account receivable. When I sold something, I debited account receivable, credited sales. So account receivable went up. And also, I reduced my account receivable. When a customer paid, I debited cash and I credited their account receivable. Also, I removed account receivable when I wrote off an account, but let's keep it simple. But this is what happened. Regardless, I might have hundreds of thousands of transactions on each side. All what I have to find out is the net change. The net change. What's the net change? The net change, I computed it already right here. My account receivable went up 26,000. So when I net everything, it looks like this period, I sold $26,000 on credit. Hold on a second. So when I net all of this, all what it nets down to, I'm going to put it in a different color. I debited account receivable 26, I credited sales 26. So after all said and done, all these transactions can be summarized if I net them out into account receivable and sales. What does that mean? Well, account receivable went up. That's clearly, I can see this from the T account. Sales also went up by 26,000. But this amount, because account receivable went up 26,000 and sales went up 26,000 as a net amount, there are $26,000 in sales that are non-cash. Remember, I only want my cash sales. It means of this amount of the 495,600 of this amount of the, let me get my calculator here, of the 495,600, 26,000 of this amount is non-cash sales. How did I figure it out? From my account receivable. And obviously the difference is 469,600. This is my cash sales. What does that mean? It means I have to deduct 26,000 from my net income. Now, if the opposite would have happened, if my account receivable went down overall, if my account receivable went down, it would have been the opposite. If my account receivable went down, it means I collected more cash than sold on account. What does that mean? It means if account receivable went down, I would have added, so if there was a decrease in AR, I would have added the decrease. Don't worry, I'm going to show you a rule at the end for current assets. But I want you to understand why I deducted 26,000. The reason I deducted 26,000 because overall I had $26,000 sales on credit that are non-cash sales. Let's move to inventory. Okay, again, inventory is a current asset. It went from 186 to 213. Let's analyze. I'm going to delete everything on this page and analyze inventory. Inventory. Let me go back and do this. Inventory, what happened to inventory? Inventory overall, inventory increased. So I have inventory and went up 27,000. Let's analyze inventory. This is where your T account is useful. It went from 186 to 213,000. So what happened throughout the year? Throughout the year, I purchased inventory. Throughout the year, I reduced inventory through cost of goods sold. So when I purchase inventory, my inventory went up. As I sold inventory, inventory went into cost of goods sold. What is the net change? The net change is 27,000. What does that mean? Well, it means overall, I end up with more inventory than I should have. Than I should have. What does that mean? It means I purchased inventory. Well, what does that mean? If I purchase inventory, it means I consumed cash. But if you look at the additional information, it says all your inventory is purchased on credit. Yes, but also I had to pay that credit. So all what I'm going to say here is, since my inventory went up, I'm going to assume I purchase inventory. If I have more inventory, it means I consumed cash. Now that's not really 100% true, because some of the inventory, it's going to be on credit. It means I purchase it through accounts payable. But don't worry, I'm going to analyze accounts payable and fix that if I made that wrong assumption. But for now, here's what we say. If my inventory went up, I deduct the cash amount. I deduct the difference. So notice, as asset goes up, as account receivable goes up, as inventory goes up, I am deducting. What's the point here? The overall idea is this. You can say this as current asset increase, negative cash flow. Because to increase your current asset, you have to consume cash. What does that mean? It means if you want more receivable, you sell on credit. If you want more inventory, you have to consume cash, either now or later. Through accounts payable, you have to consume cash. So you can take this statement to the bank. As current asset goes up, cash flow goes down. And guess what? As current asset goes down, we assume cash flow goes up. Well, let's look at this example. Prepaid expenses. My prepaid expenses went from 18 to 15. So what's the net change? Prepaid went down by 3,000. Automatically, what are you going to say? Add 3,000. And the answer is yes, but we need to understand why. So let's take a look at the prepaid account. Prepaid went from 18,000 to 15,000. Overall, there was a decrease of 3,000. Now, throughout the year, I purchased prepaid and I expensed prepaid. But the net amount is negative 3,000. So when you reduce the prepaid, how do you reduce the prepaid? How do you consume your prepaid? This is how you consume the prepaid. You debit an expense of 3,000 and you credit prepaid to reduce the prepaid of 3,000. So if we summarize all these changes, all what it summarizes to is prepaid went down, expenses went up. It means I am recording an expense that's a non-cash, just like depreciation. So I recorded an expense, but that expense, I did not have to credit cash for it. What did I credit for it? I credit prepaid. So why didn't I credit cash? Because I purchased that prepaid in the past. It means what? It means I have to add the decrease in the prepaid because I did not consume cash. Now the opposite would have been true. If my prepaid went up, how do you acquire prepaid? If you have more prepaid, it means overall you paid for the prepaid. By its definition, you prepay to get the prepaid. So if you prepay for something, overall, the net change is increase in prepaid. It means you consume cash. You would have deducted it. But here, the prepaid went down. Again, the rules are simple. Current asset goes down. You have more cash. Why? Because you are using your prepaid. You are not using your cash to record your expenses. Now, so we analyze all the current assets. We're not done yet because we analyze the current assets. What else we have to analyze? We have to analyze the current liabilities, and we have 3 of them. Now we're going to learn about the rules how to analyze current liabilities. Now this is, we're looking at now CL. Starting with accounts payable. Accounts payable went from, this is accounts payable. Let's analyze it. Went from 140,000 to 179,000. Okay, there was an increase of 39,000. Increase of 39,000. Let's explain. Let's just kind of understand this increase. So again, we had many transactions. We purchased on account. We paid off accounts payable. All in all, The net change is an increase. What does that mean? Well, let's think about it. It means you purchase things. When do you credit accounts payable? You credit accounts payable when you buy inventory, when you buy supplies, when you buy goods and services. You debit this account and you credit accounts payable. That's what happened. So overall, the net change is how much in accounts payable? 36. It means you acquired asset worth of 36, I'm sorry, not 36, 39. You acquired asset worth of 39,000 that are non-cash. You purchased them on account. Well, it means if your current liabilities, if your accounts payable went up, it means you are operating the business without paying cash. As a result, you add the change. You add the change because you purchase inventory and supplies and goods by crediting accounts payable, by not using your cash. That's good. Now, what would you say if we had a decrease in accounts payable? The opposite would have been true. When do you decrease your accounts payable? You debit accounts payable and you credit cash. If the net change was a decrease, it means overall you paid off your accounts payable. If that's the case, it would have been a negative. So here's what we say. I'm going to give you the rule. If current liabilities goes down, it means cash flow is negative. If current liabilities went up, it means your cash flow is positive. And this is what happened here. My current liabilities, I have more liabilities. It means I am borrowing money to operate. It means I'm not paying it now. So that's accounts payable. And that's important to understand, that you analyze accounts payable this way. And all liabilities are the same, basically. The rule, you can take this to the bank. Now let's analyze interest payable. Let's do that. Interest payable, there was a decrease of 2,000. So this is interest payable. Went from 8,000 to 6,000. So many things happened, but the net was a decrease. Again, many things happened throughout the year, but the net was a decrease. So this account went down, this liability went down by 2,000. How do you bring down your liabilities? It means overall, we debited interest payable overall 2,000 and we credited cash 2,000. So if you net all the transaction in interest payable, debiting, crediting. So when do you debit also interest payable? When do you increase interest payable? You increase interest payable when you debit interest expense, you credit interest payable, kind of, if you're not aware of this. So when we net all these transactions, debiting interest expense, crediting interest payable, all in all, what's left is we paid off interest payable by 2,000. Well, if we spend an additional 2,000 to pay off interest payable, interest debt, it means we used up the cash. So if current liabilities goes down, you guessed it, cash goes down. Good. And I'm pretty sure you're going to figure out income taxes payable. Income taxes payable. Now, what happened to income taxes payable? It increased. Same, it's a current liability. So let's take a look at this transaction and analyze it, because it's very important. The more you do, the more you work examples, the more you practice, the easier it's going to be. But again, memorize the rule and try to understand it. So taxes payable, I'm just going to call it taxes payable. I could just call it payable, any payable. And this payable went from 18,000 to 24,000. Okay, what does that mean? It means it went up, the net effect, it went up by how much? You guessed it, 6,000. It means if we net all the transaction and taxes payable, what happened is this. We debited taxes expense, because this is what you do when you increase taxes payable, and you credited taxes payable. The net effect is an increase in expense of 6,000 and an increase in payable. This is the net effect. Well, what does that mean? It means I recorded an expense, but I credited a payable. I did not pay the expense now. What does that mean? If I did not pay the expense, it means it's a positive to my cash. It means I recorded an expense that reduced my net income, but did not reduce my cash. Therefore, what I do is I go back and I added back. And basically, I'm finished with the liabilities. Remember the liabilities, current liabilities goes down, cash flow goes down, current liabilities goes up, cash flow goes up. And this is not only for current liabilities, all liabilities. And the same concept for assets. If asset goes up, cash flow is down, because if you want to acquire assets, you have to consume cash. If you are consuming your assets other than cash, it means you are not using your cash flow. It means your cash flow is being saved, cash flow up. So the liabilities, we can say it's a positive relationship. They work the same way. For the asset, they work the opposite way, inverse. Now we are ready to sum up the operating section. So we started with net income, step 1. Remember, this was step 1. This was step 2. This was step 3. This was step 4. And those were step 5, analyzing current asset and current liabilities. Then we net them out. And the company made $554,600 net income on a cash basis versus the net income, the accrual net income. And this is which section? This is the first section of the cash flow statement. Now, obviously, we're not done. Why we're not done? Because we still have to do what? Compute the investing section, compute the financing section in order to do what? In order to finalize, finish, get done with this statement of cash flows. What should you do now? What should you do now is go to Farhat Lectures, look at additional MCQs, look at additional resources, lectures, exercises, examples. That's going to help you, whether you are an accounting student, a CPA candidate, CMA, or you're just taking this for your own knowledge. Invest in yourself. Farhat Lectures is always here to help. Good luck and stay safe.